Hello, everyone, and welcome. It's wonderful to have you all here. Now, please join me in welcoming Jim Bianco, the president and macro strategist at Bianco Research. He's unencumbered by the biases of traditional Wall Street research and has built a decades long reputation for objective, incisive commentary that challenges consensus thinking. Now, to our live viewers, please share any questions you may have throughout this session in the chat box. Jim will be happy to answer those, time permitting, as we go through the presentation. And with that said, I will hand the mic on over to you, Jim. I'll be here if you need me, but the floor is all yours.
Thank you, Charlotte, and thank you, everybody. It's a great pleasure to be able to kick off this virtual conference. As Charlotte said, I've got a chat window here open. If you got any questions, just drop them in, and I'll try and answer them along the way. Hopefully, you can see my handout. I can telestrate on my handout, as you can see. I'll channel my inner John Madden along the way. Topic is, should the Fed cut rates? No. Thank you very much for inviting me. Have a good day. No, seriously. I want to make the case for the Fed appears, let me back up. When you talk about the Fed, there's always what will they do and what should they do. Will appears to be that they are going to cut rates at the September meeting. What should they do? I don't think they should be cutting rates at the September meeting. That can be a problem. And I want to talk about inflation. I want to talk about growth, especially labor. And I want to talk about the response or where the position is in the general financial markets in order to try and make that case. But before I start that, because I'm very bad at doing this, I do want to mention that we do manage an index called the Bianco Research Total Return Index. We discretionally manage that index, and there is an ETF with the ticker WTBN that tracks our index. So think of it like the S&P Index Committee sets the S&P 500, and SPY or IVV or VOO just track the index. We set our positions on our index. It's a fixed income total return index. It is designed for fixed income investors or anybody who wants to be a fixed income investor to try and get yield and appreciation, and they're not really sure what they should be doing in the bond market. That's what we do with our index, and that's what WTBN tracks us. Through June 30th, according to Morningstar's ratings, we were easily in the top half of our index for all of 2013 throughout from 1 month all the way through the last year. We were in the 13th percentile, meaning that we outperformed 87% of the funds in our universe. There, I got that out of the way at the beginning because I tend to forget about that at the end. But let me talk about now the big topic, and this will feed into the way that we set our index, manage the ETF that follows it too. Should the Fed cut rates? So July 30th, Jay Powell held a press conference. Two headlines that took away from this. Inflation is further from our goal than employment. The totality of the data says we've got a solid labor market. Well, of course, we know then 2 days later, we got the exact opposite of a solid labor market, and we had a big reaction in the market. So let's talk about this chart here real quick. This chart shows you the probability of a Fed cut at the September 18th meeting. This is based on the Fed fund futures. You can calculate those odds. So that press conference where I showed you earlier where Powell was, we were at 66% before he spoke, and we went to 39% after. Then we got the payroll report, and I've got some slides coming up on that. We got the payroll report. We went from 39% to 98% in an hour and a half. That we were going from most likely not going to cut rates to almost a certainty that we were going to see a rate cut. And currently we're at 84%. So what I'm trying to show you here is the market is expecting a rate cut. But I would caution, though, that it's not necessarily that the market wants a rate cut. It just thinks it's going to get one. Whether or not it wants one is a different issue. So let me show you two charts here to kind of get this point across. Last year, the Fed cut rates last year, September, October, and December. So they cut rates a total of 3 times for 100 basis points, or 1 full percent. That's what this chart shows. And as this line shows, the funds rate went down. But the orange line on the chart is the 10-year yield. It went up during that period. So even though the Fed cut rates, and I know this is what President Trump constantly puts on Truth Social and stuff, cut rates, it's rocket fuel is what he says. Rates will go down. He says Jay Powell's too late. He's a numbskull. He's a moron for not cutting rates and giving us all of this. The problem is what this chart shows is you can cut rates anytime you want if you're a central bank. Does the market agree with you? Does the market think it's the right thing to do? Because if it doesn't, interest rates go up. By the way, that's not an unusual circumstance. The ECB, the European Central Bank, has been cutting rates since before we started last year. They've cut rates a total of 7 times. They have cut rates 1.75% is what they've done. President Trump goes, be like the European Central Bank. They've been cutting rates. Look at what their 10-year yield has done here during that period. It is up 87 basis points or almost 1 full percent. Why did it go up as they've been cutting rates? The market does not think this is the right policy. And that's the thing. Like I said, the Fed could cut rates in September, but will the market think it's the right policy? We don't know. And why does that matter if you're not, steeped into the, the bond market and the stock market and stuff? Let me show you this chart here. The blue line here is the national average of a 30-year fixed rate mortgage. Bankrate.com surveys hundreds of banks and mortgage brokers. It was 6.65%. Actually, they released it this morning. And the orange line here shows you the 30-year yield. Here's the spread between the two. On the bottom, there was a big bulge. In other words, the gap between the 30-year and the mortgage and the 30-year mortgage and the 30-year treasury widened out quite a bit. That is narrowing now. That has more to do with the intricacies of the housing market is what caused that to widen. But you don't want the 30-year to go up because that will bring mortgage rates up. And I know the argument is, well, cut rates. Well, the problem is if you cut rates and it's a mistake, you're going to wind up pushing the 30-year rate higher. So why do I think it's a mistake to cut rates? So let me start with a couple of charts here, and let me start with inflation. So we got the CPI report, and I'm breaking it down here to X food and energy, food and goods. Now, I know some people like X food and energy. What, you don't drive, you don't eat? Yeah, I get that, but food and energy tend to be driven by things other than monetary policy or the general level of inflation, like weather or shortages or embargoes or stuff like that. What I want to show here is that the core inflation rate is 3.1%. Goods inflation is moving higher, and even services inflation is starting to drift up. When the last time the Fed cut rates, when the core inflation rate was 3.1%, was last year. And that's when they did this and rates did this. The last time they did it before last year, in other words, they cut rates, the market said too much inflation, and interest rates went up. The last time they cut it when it was 3% was 1991. So it was 34 years ago. So it would be very unusual for the Fed to cut rates like that. So why is it that goods prices are moving up? And what is it that we have to be careful of? Tariffs. Here is the average tariff rate for the United States all the way back to 1909. That's 1909 is what that is right there. This red part is this year. And that's what tariffs have been doing this year. Here's a daily chart. Yes, now we have to have daily charts of tariffs. And you can see that they've gone up and down. This is this peak here was when we had the tariff war with the Chinese. We went to 145% before we backed off. The blue line here is the average tariff rate we're paying. This is the total amount of tariffs divided by the value of goods that are coming. That'll lag the actual tariff rates. It will eventually converge like it was in January, but it's going to keep going higher as well. And so that's what you see here on this chart. How much tariffs are we collecting? Well, before Liberation Day, April 2nd, we used to collect about $6 billion of tariffs a day. Now we're collecting about $27 billion of tariffs a day. I'm sorry, tariffs a month, not a day. Tariffs a month, $6 billion a month versus $27 billion a month. What that works out to is we're collecting an extra $300 billion of tariffs a year. Somebody's paying these tariffs. These tariffs are not just magically going into the Treasury's coffers and no one is actually paying it. So someone is paying it, and the fear is that someone is you and me. So Price Stats, this is a service that's owned by State Street Bank, does a daily measurement of goods prices on the internet. They look at Amazon and a lot of other ones. So the orange line here is imported goods subjects to tariffs. Those tariff rates are rising at 4.48% per annum since Liberation Day, nearly a 5% goods price. Products that originate from China, I'm not showing you here, but they're rising at almost 7% a day. And then domestic products that don't have tariffs are not moving up. So if I was to go back to this chart here, this goods price moving up is suggesting that we're going to see more inflation as we move forward from here. And we might already be seeing that more inflation. We got the producer price index, PPI, producer prices. This is the prices that the companies charge to companies. It jumped big in July, its biggest jump since we had the inflation problem 3 months ago. So there is evidence that we're starting to see inflation. Then there's this other quirky measure that Jay Powell likes, which is called Supercore. This is core inflation less housing inflation and housing services. Measures what Supercore is supposed to measure is wages. It has started to move higher, and all the individual components of it have started to move higher too. So this is not necessarily the best time for this to be looking to cut rates, because we've got an inflation problem. Final thing on inflation before I move on to labor is this is the seasonal factor. The way that they do this is they calculate the index on a not seasonally adjusted basis, and then they apply a seasonal factor. You can see the seasonal factor is U-shaped. And there is a thing called residual seasonality. All that means in English is the inflation rate during the year tends to follow the seasonal factor. It shouldn't. That's what the seasonal factor is supposed to get rid of, but it does. Meaning that you get the lowest inflation rate during the middle of the year and you get the highest inflation rate at the end of the year. Well, it's August. What we're looking at for the seasonal factors for inflation is it's going to be pushing it higher. So the inflation rate's going to keep up. If the Fed wants to cut rates into the face of higher inflation, they could see another rejection of their policy like they saw last year or the ECB is seeing now and produce higher interest rates. That's why I don't think they should do it. The next question is, well, what about the labor market? Didn't we get some bad reports? Well, let me talk about the labor market. There's 164 million people that have jobs in the United States. We also measure the unemployment rate at 4.2%. I'll show you those charts in a second. Those are population measures, is what they really are. And what drives those numbers is the population growth of the United States. Well, here the black line on this chart is the population growth of the United States, and it's broken down two ways: births minus deaths in blue and immigration in red. And what jumps out about this chart is two things. First of all, we had a surge of population growth. That's when we had very open border and a lot of immigration. And you could see that the red line was driven, that surge in population was driven by immigration. And then we've seen that it's been slamming shut. Then we've seen it's been pulling back because President Trump has slammed shut the border. So what population growth is driven by is largely driven by immigration. So what's happening now is that the immigration has really dropped off to almost nothing. As a matter of fact, President Trump tweeted out or put on Truth Social, we have net negative immigration, he said, for the first time in 50 years. What does that mean? More people are leaving the country than entering the country. Why 50 years? Because that's all the data we have. That might be the first time in American history that foreigners are net leaving the country. And we might be having the lowest population growth outside of a war pandemic in American history. Now, what I mean by that is we had negative net growth during the Civil War and during the Spanish flu in 1918 because we had millions of people die. We also had very slow growth during COVID. But short of that, right now, we have got one among the lowest growth in the country. Also, the number of ICE detainees has been moving up quite substantially during this period as well. We have now got 56,000 people in ICE detention, versus on inauguration day, it was 40,000. So 50% increase. So we're trying to get all of the illegals. And of course, what this chart does show us here is half of them that are in detention either have a warrant out for their arrest or they're convicted criminals. And so this is really having a big chilling effect on the population growth in the United States and the labor markets. Now, before I turn to the labor markets, I want to point out one other thing. This is a Wall Street Journal poll from last month, and it looked at various issues. And I want to point out here, I boxed illegal immigration. The thick line here is Trump's net approval rating. The only thing that Trump has a net approval rating on is his handling of illegal immigration. And the green line, the green bar here is the net Republican versus Democrat, that the public is more favorable about Republicans' handling of immigration than Democrats. So if you look at this population growth, the shutting of the border, and the implications it has, as I'll show in the next set of charts, it's not going to go away. This is the Republican and Trump's most popular issue. This is what the country wants from him, so it isn't going to change. Now, you may want this, you may think, you may abhor this. I'm just trying to say this is the reality that we live in. All right, so let's talk about a statistic called potential growth. What is potential growth here, real quick? Potential growth is how many jobs does the United States need to create because of population growth? Well, but pre-COVID, we used to think it was around 80,000 a month, and that's what that black line shows. Now with low immigration, and this is what the red line shows, under a low immigration rate, we could be looking at the potential that we only need to create 20,000 jobs or maybe as low as 10,000 jobs, and in some scenarios, zero, within a year. So when we look at what happened to the payroll report last month, and this is the net jobs revision on the payroll report, that it was one of the biggest negative revisions we've seen. Now, we saw one bigger during COVID, but that was an unusual circumstance. We lost 20 million jobs because we shut down the global economy. We saw one that was slightly bigger during the financial crisis in 2008, and that was it. So what's going on there? In order to get jobs, you need workers. In order to get workers, you need a growing population. If you slam the border shut and you don't bring in new workers, you don't have them to fill those jobs, and you don't need to create a lot of jobs. So really what I think is happening is people are looking at 19,000, 14,000 jobs. And if I was to go back to my chart here real quick of the probability of a Fed cut, they freaked out and said, oh my God, the Fed's got to cut rates. The economy is going into recession. No, we have no population growth. We have nobody to take these jobs. This is the world we live in, and that it is going to be a slow immigration, or excuse me, a slow payroll growth environment. And it isn't going to change, if I was to go back to this chart here, because it's the most popular issue that Trump has. It isn't going to change. So that's really what is the big issue. Now, the question is that economists ask is this population growth is this slowdown because of the lack of labor supply, that's population growth, or demand? Companies are weakening, companies are in trouble, so they're stopping to employ workers. Well, let's look at the demand statistics. Weekly initial jobless claims. If you lose your job, you can file for weekly unemployment insurance. Here's the latest number. It's right on its 4-year average. There's nothing there to suggest that there's a weakening in the market. The unemployment rate is 4.2%. It was 4.2% a year ago. There's nothing to suggest that there's data that suggests that the unemployment rate is rising that would suggest weakening demand. Here, by the way, is the long-term picture of the unemployment rate. It's averaged 6%, so that 4.2 is well below its average right there as well, too. Earnings growth. Average hourly earnings, 3.9%, not weakening. It is not suggesting that there's a weakening of demand. So that is another issue that we got to start to think about as well, too, is there a fall off in wage labor? And the answer is no. So really what we're doing is we're not adjusting. We now live in a zero population world. We don't need to create that many jobs. We didn't, and we think that's bad. The Fed has to cut. We have an inflation problem. I think that's going to be problematic, and we run the risk that the market could reject it. Now, we got Jay Powell speaking Friday at Jackson Hole. Maybe he changes that narrative on Friday, but right now this is the narrative. Lastly, I want to talk a couple of quick things, and I'll take your questions. If you've got any questions, go ahead and put them in the window as well. What about the financial markets? Well, what are they suggesting is the state of the economy? Let's talk about S&P 500 earnings growth of earnings. Right now, Wall Street is estimating it's going to be 10.53%. That is a good number, 10.53 right there. That is pretty much average. Now, this, of course, is a distortion because of the pandemic shutdown and restart. But if you take that out, that's not a bad number. And if you look at Wall Street's earnings estimates, so this is every week. It's a calculation done by Bloomberg of what does Wall Street think about earnings. Second quarter numbers went straight up because the report was very good. But if you look at the third quarter in gray, the fourth quarter in black, and the first quarter of next year in blue, they're all starting to swing higher. There is nobody on Wall Street that is suggesting that they should be downgrading their numbers because the economy is in trouble. Companies offer guidance. This is an index of company guidance. They used to tell us companies would guide us, the CEO come out on the earnings call and say, next quarter, our company's going to earn $2 a share. And then they update it, say, you know what, we're probably going to earn $2.10 a share. That would be positive guidance. Or if they say, no, it's not going to be 190, that would be negative guidance. So this is an index. This number is the highest in 4 years. This suggests that companies are coming out and saying, our earnings are forecasted guidance for earnings. It's actually better than what we think it's going to be. So there's no evidence within earnings reports or Wall Street's opinion that the economy is slowing. Yet we're going to get a rate cut. And the risk is the market's going to say, we don't need it. The risk is the market's going to say, we're just pushing too much into this. We're going to push too much stimulus. And all it's going to do is create inflation. And you could wind up with higher long-term interest rates. Lastly, I want to talk about the stock market a little bit. Let's talk about the valuation in the stock market. Does it need it? Stock market capitalization, the percent of nominal GDP, otherwise known as the Buffett indicator, is over 200%. That means the stock market is twice the size of the U.S. economy. Its long-term average is 72%. That is a very heady number. My favorite metric on valuing the stock market is this one. This is what's called the hopes and dreams metric. It was done by Cameron Christ over at Bloomberg. He's a macro strategist over at Bloomberg. He starts off with, here's the S&P at 6,400. He then asks, what's the book value of all of the companies in the S&P? 1184. He then says, what is the net present value of earnings over the next 3 years? Yes, Wall Street does give you earnings estimates over the next 3 years. Net present value them. That's another 816 points. That means that 4389 points of the S&P is defined as hopes and dreams. What is that? That's this chart. It's a company. It's not a stock. It's not a commodity. Companies are live organic organisms. They change their product. They change their management. They change their strategy. So you should expect that a company is worth more than just the price of its assets and what you expect it to earn. There should always be a hopes and dreams part. It should always be above zero. And what this chart shows you is hopes and dreams have always been above zero. Companies will remake themselves. They'll invent new products. They'll go in new strategic directions. But it's 69% of the earnings of a company's or the S&P is made up of hopes and dreams. That's pretty high. The only other time it's been higher than that was the tech bubble at 70%. Or let me put it to you this way. Whenever you see it this high, 69%, here's a scatter graph. This is the hopes and dreams. Here I put 69 to 70% in the shaded area. And this is what does the stock market return over the next 3 years? It's negative. It's below zero. Why does the stock market return? Because you're paying too much for the stock market, and that you need an absolute blowout in earnings to justify it. There's another way to look at it. The Shiller PE, cyclically adjusted PE ratio. Bob Shiller won the Nobel Prize in 2013 for this asset valuation metric. He's got it at 38% right now. Or 37 is his PE ratio. Now, these valuation measures, I want to be clear about these valuation measures. They're not timing tools. They're not going to tell you what the market's going to do next year or in the next 10 years. What they're telling you is, and let me go to this chart. Here's the scatter graph. Here's the P between 36 and 38. Here's what the stock market returns over the next 10 years. It's in the negative category. Doesn't mean there's going to be a crash. It doesn't even mean that the next year is going to be bad. It means that if you hold on to stocks long enough, they will disappoint you in this environment unless you tell me AI, government regulations, something else means that companies are going to be minting money and people are going to be throwing money at companies and they're going to be making gigantic profits, because that's what overvaluation means. You are expecting gigantic profits and earnings coming from these companies. And the reality is they rarely do give you those gigantic profits as well. And that's why I think over time the market will struggle. That's why I think that the bond market with a 5% yield is a good place to be. That's why I started my index and bond funds. So let me sum it up. The Fed's going to cut rates. I don't think they should. Maybe Jay Powell changes that on Friday. Inflation is too high at 3%. The problem with the labor market is we need population growth. In order to have labor growth, we don't have population growth. So we're going to have slow labor growth. That's okay. If you don't have population growth, you're not going to have labor growth. And if we're not going to have labor growth, I think the problem is people have not adjusted to that. They still think we need 80 or 100,000 jobs a month. If you're going to stimulate the economy, you're just going to produce inflation. And that's why I think interest rates are at risk of going higher. All right, I got a couple of minutes left. Let me take some of your questions. Craig asks, any metrics for the impact of AI and robotics impacting the job market? No, there really isn't any measures, but let me give you a couple of thoughts. Bill Gates famously had a line that technological changes like AI and robotics over the short term, the next 3 years, will be less than what you think. And over the next 10 years to 15 years will be more than what you think. Count me as one that thinks that robotics and AI is going to matter more or as much as the invention of the internet. But it's going to be very slow in coming at first. But it's going to come later. The last thing I would tell you about it is Bob Gordon, economics professor at Northwestern University, wrote a book about labor and productivity and technology. And in his book, he said, technological advances, AI and robotics, are technological advances, are net creators of jobs. So let me bottom line it for you because I'm short on time. Over the next 10 to 15 years, AI and robotics will probably eliminate 50 million jobs of that 164, a third of those jobs. Wow, that's a lot. That sounds terrible. No, it's not, because it's going to create 60 to 70 million new jobs. We don't know what those new jobs are. They're going to be in whole industries that don't exist. And it's going to be millions of people that are going to be employed in those industries that do not exist. When Steve Jobs held up the iPhone 1, did you say to yourself in 2006, the iPhone 1.0, did you say to yourself, man, that's the end of the taxi industry? You didn't realize that the App Store and the phone was going to change things, and we're going to create Uber, we're going to create Airbnb and disrupt the hotel industry. That's what's going to happen. It's going to be a net creator of jobs. A lot of us might be working in an industry in 10 years that does not exist today because of AI. So no, it's not going to impact it immediately, but over the longer term, it will. Do you think reshoring could help the employment numbers? Yes, it can, but here's the problem. The first step of reshoring is going to be construction jobs. I need bodies to be construction workers. We ship them out of the country. I mean, I'm just trying to be blunt about it to get my point across. So how am I going to get those bodies in order to get those jobs? I'm going to have to take people and pay them more money. That's wage inflation. That's higher inflation. That's higher interest rates. I'm talking about what it means for the economy. And so, yes, it can mean that, but we need more bodies. Again, it's the most popular policy that Trump has, shutting the border. He's not going to say, oh man, we need more construction workers. We better open the border and let them in, because the public is approving of this and he's approving of it too. So it leads to the potential of wage inflation. Last question, because I got 1 minute left. There's usually about 120 basis point difference between the funds rate and the 10-year yield. If we want long rates to stay where it is now, and it calls for about a 3% funds rate, what say you, Jim? The Fed thinks that their target rate is 3%. I think it's 4%. The Fed thinks the target rate is 3% because they think the long run inflation rate is 2 plus 1. I think it's closer to 3 is the long run plus 1. I think 4% is where the funds rate should be. I think 5.5 is where the 10-year yield should be. We are positioned for that in our fund to try and take advantage, or in our index, in the fund that tracks us, to try and take advantage of it. I want to keep you on time. Thank you for listening to my arguments about why the Fed should or shouldn't do. It's right at the top of the hour. My time is done. There is the handout. I sent it to Charlotte. If you want, request it. You could get it, or reach out to me if you got any other questions. Thank you.
Well, Jim, thank you so much. It's been wonderful having you present as always at our Money Show virtual expos. Thank you to our live chat for some great questions. And be sure to stay tuned as we have a lot more in store for you in this Money Show virtual expo. I hope everyone has a wonderful rest of your day.